Welcome to the Investment Process Channel. I am C3 Christopher Campbell. This is a channel where we teach people how to create generational wealth through trading. Look, my man Riley Coleman has put a 3 proven trailing stop strategies that maximize profits. Everybody knows I'm about trailing stops. I think it's a great way to lock in your gains as the market is moving. Myself, sometimes we get distracted, phone call, something happens. We're trying to focus in, and we have to take the call or whatever. Having a trailing stop is that insurance that you lock in your gains as the market is moving in your direction. Of course, we have to have a stop in place. The trailing stop, I think, is a very good practice to have, especially during breakouts. So I mainly use them during breakouts. Will I use a trailing stop during a range order? Yes, definitely. It won't be as aggressive, but definitely for breakouts, it's a good practice to have a trailing stop. So let's see what he has to say. It's about 11 minutes. He has some good nuggets. I think I've seen some of his other stuff. So this is a great guy, though. I think you guys should go over and check his channel out. Let's take a look. Okay, got to put my headset on. All right, let's go.
If you are not using a trailing stop, you are 100% leaving money on the table. And nobody likes to do that. We're going to go over 3 different styles.
Okay. Absolutely. We don't want to leave money on the table. The same thing I put in my trailing stop video for Tradeovate. Probably the link will be somewhere, one of these places here. So he has a bonus. He has 4 different ones, but ATR, average true range, that's a lagging indicator. I'm interested to see how he uses that. EMA, exponential moving average, another lagging indicator. I'm not big fans in lagging indicators for using. Price action is pretty much what I use. And then there's a bonus. So let's definitely see what he has. Let's go.
And after that, I'm going to walk you through some live examples so you can see how this works in real time. Now, these 3 styles are progressively going to get more complicated, but as they get more complicated, they're going to get progressively better at maximizing your profit. So let's first start off with the ATR, or average true range. And so all this indicator does is it puts a line on your chart either below the price for when the market is going up or above the price for when it is going down. And so what it does is it tracks what the average pullback is in the market. If you got in a trade down here as a buy for going long, you're going to use the ATR to say, hey, I want to stay in the market as long as the pullbacks are consistent and normal in this market. So every one of these pullbacks, because they haven't broken below this blue line, are normal and a part of the current market trend.
Yeah, so what you guys can't see, he's this goes on any timeline, depends on when you go in. It looks like he's a scalper. He's on a 1-minute time frame. So this is a 1-minute time frame, and his ATR, I believe, was 21. So, and if you know 21 is one of the Fibonacci sequence numbers, go look up what the numbers are, but 21 means he's using the ATR is using 21 sets of data to plot that line. So 21 previous sets of data and saying, okay, here's where price is pulling back to or just outside of, right? So it's using previous data to say, okay, the market is still going in the direction that you want. I think this is pretty good. Yeah, right here, that's when you would be looking to get out, right? Once price is not, well, it got close here, then it bounced. This is super close. So yeah, it's probably a good way, especially if you're a beginner trader, setting these lagging indicators up. So just so you can understand price action, because you saw the third one is price action. until you understand what price action is, I think these are great indicators to have to figure out where you need to trail your stop. So my thoughts are, if he's doing this, that where the plateau's at, you remove your stop loss up to here, up to here, up to here, and you would continue to do that. Like, well, right outside of it. I wouldn't put it right on top of it, but like right outside of it, and right outside, right outside. And you would continue to do that as price goes in your direction, and you can trail your stop that way until price doesn't go in your direction, right? So if you put it right outside here, let's say it goes against you, then you're out. However, you still have all these that was in your favor. Great plan, great plan.
And until it breaks that, right here we can see it, the price breaks below that level. That's when we want to get out based on the ATR, because the pullback is greater than what the average has been previously in this current trend. And on my platform here, NinjaTrader, it actually prints you a little arrow that says, hey, the ATR is broken and you should get out. And that.
And he's on NinjaTrader. I don't think I trade on TradeView and Tradeovate. I don't think I have not used the ATR. I'll check and see and maybe make a video for it, but I'll take a look. But that's cool. That's cool.
Is a great trailing stop strategy, and it is very simple to execute. Now, of course, like everything in trading, it is not that simple and does not work that great every time. Where the ATR falls short is in a choppy, range-bound market. It works really well in those kind of easy, slow-moving trends, but when you're in a range-bound market like this, where the market's just whipsawing back and forth between support and resistance zones, it does a.
So typically what I call these zones are those consolidation zones where, like he said, you get into a support, like maybe price is going down, you hit support, and it'll start moving within a small range before it decides what it's going to do. But it's a large enough range where some people still trade it when they get like 2 to 1s real quick, or whatever the situation may be. Again, he's trading on the 1 minute time frame. So yeah, the ATR is probably not going to work.
A terrible job at maximizing your profits. For example, let's say we got in up here as a short because it's near these highs, and we looked to bet that the market was going to go down here. Well, because the ATR is struggling to keep track of what a normal pullback is, because the market's being inconsistent and whipsawy, well, the market sold off all the way down here, probably getting you a really, really good amount of profit on the trade at its peak, but you got knocked out all the way back here. And that's pretty much giving back 50% of your profits. And so that is where the ATR falls short. Now, what you can use instead that captures situations like this better is an exponential moving average trailing stop. And so all that is using an exponential moving average. And I have this set to a 21 exponential moving average. And the basic idea of this is when price breaks your exponential moving average, you get out of the trade. So if we got in short up here, betting the market's going to go down, we stay in all the way until this bar right here breaks.
So they have SMAs and EMAs. So SMAs is simple moving average. EMAs is exponential moving average. Again, using the Fibonacci numbers, again, look them up on your own time. Type in Fibonacci sequence, you'll see the numbers. 21 is a good number to have that piece of data be valid, right? So if you're looking for bigger moves, then the bigger your number would be. So if you're trading on 4 hour, daily, things like that, your number should be bigger. I used to trade like I think it's 89 and some other numbers higher than that to see the overall move of the market, but on a smaller time frame, 21 I think is a good number.
Makes above that moving average. And so comparing that to our trailing stop, it does a lot better in capturing those profits. Now, if we jump back to the initial example where the ATR did so well, the exponential.
So let's take a look real quick, and I think Riley hit the nose on the head. So If you're trading within a range, I think the EMA is probably a better tool to have. If you're trading more of, you notice a breakout happen, either going to support or, going to a new high, then yeah, probably the ATR is probably a good way to use that to trail your stop and follow behind it.
Exponential moving average definitely doesn't perform as well in these type of markets. You can see that right here it got knocked out right here and here as well. But what you can do in these situations.
So again, that's the difference. Trailing a breakout, you probably want to use that ATR. And that's, you have to know what you're trading. Trading a breakout, or like I said, a large move, ATR. Trading within a range, looks like EMA is probably your best bet. But these are great techniques, two great techniques.
Situations is you can modify your strategy briefly. An example of that is I want to see the market have 2 bar closes below the moving average. So if it just has 1 candlestick break below and then immediately recovers it, that's totally okay. The market is, in my mind, I've seen that it's holding the exponential moving average, and the moving.
See, I just said use larger EMA for slower trends like a 34. See, he bumped it up from 21 to 34. There you go. He said exactly what I said.
Average is keeping price up. Now, eventually, based on that, you do get knocked out at here, and that's totally okay. Of course, you're not going to find an indicator that works perfectly in every market. The idea is finding something that works consistently enough to help maximize your profit. Now, to make things a little more complicated, let's look at this second example right here. Right here, when we get in, you can see that, hey, the exponential moving average is basically knocking you out right away if, let's say, we got in on this big bearish bar right here. And so what you can do, and I think what you should do, is use a trailing stop at a certain point in the trade. Let things get going first. Because quite often when you get in a trade, the market will chop around for a while. Because, at least for me, I like trading reversals in the market. And when you're at a, let's say up here, a resistance level, the market's going to bounce around a little while before it gets going. And so I don't want to implement a trailing stop strategy too soon and get knocked out before the market takes off and you just miss out on a massive trade. You have to take risks in trading. And so I think the best way to do that is once the market gets going, that's when you put in your trailing stop. And so an easy way to do that is once the market hits 1 times your profit, or maybe 1.5 or 2 times your profit, that's when you put in your trailing stop, because you don't want to get knocked out of a trade too early.
So yeah, that's something I said on my trailing stop, as far as like moving your stop to break even or moving forward. I'm curious, when he's saying this, if you can put this program into NinjaTrader for EMAs or ATRs, and the actual trailing stop follow that line. That would be cool. I don't know that that's the case. I would have to look it up, and when I find out what it is, I'll post it. But yeah, that's cool.
And so the last most versatile but hardest trailing stop strategy to use is using pure price action. This is 100% based on your ability to read the market in real time. Now, this is not easy to do. This takes a lot of experience in the market. But if you can do this, you can consistently adapt to the market and make your profits as high as they can be. And for me, this is my favorite way of doing it, because with a day like this, where the ATR does really well, you can do really well as well. If we got in up at this resistance level, betting the market is going to go down, you would see that, hey, the market is making lower lows and lower highs. And that is a basic way to say the market's in a downtrend, and I'm betting that the market's going to go in a downtrend, and so that's good for my trade. And then all of a sudden it starts puking lower. That looks great. And it pukes lower really quickly. And then it starts to chop around here a bit, but it doesn't really start making higher highs. And then all of a sudden we start to get a bounce here. And once you start seeing these higher lows here, you can get out. And so you can stop out right here. And so that captures the same amount the ATR does when it is at its best. And if we go to our choppy range example where the ATR doesn't do great, the EMA does good, well, reading the price action does good as well, because we would get out right down here when the market started to break this lower lows and lower highs move as it breaks above this previous high. And so that's all you're doing with price action trailing stops, is you're just reading.
So price action takes time. So I do believe, going back to what he said, using the ATR, using the EMA, that'll start you to understand price. And like he said, he saw this breaker structure right here happen. So he was fine. It bounced, but then he had a breaker structure to another low, a lower low, came down. Now it did not break this structure here. Got a little doji, came back, found support. It didn't break this low. So he's seeing this. He's like, oh, price action. It didn't take out this low. I wanted it to take out the low. Let me see. He's still on the 1 minute. It did not take out this low. Price came right back up, broke this structure. He's like, oh, momentum is changing. Came and got support and then took off. And he probably got out somewhere around here. Just closed out his order. But he had all of this to watch. Price get support. Price hit resistance here. Found support here. Resistance. Created a lower high. Lower low. And then, yeah. So, great job. But again, it takes time to be able to see this kind of price action in real time, especially in real time. And this is on the 1 minute. So if you just take this time here, that's like 5, 10, 15, 20. So it's like 30 minutes he set and watch price action. So that also comes with patience and time over time. And that's another reason why I use ticks. If you're watching ticks go, it's a little bit different than watching money. And, you get nervous. You're like, oh, I'm up. And then, then you close out up here. As soon as you see a little resistance, right? As soon as you see support form right here, but then it breaks the structure and then it continues down. But you see that, you might be out. So yeah, definitely, this guy Cody, Riley Coleman, he's on point.
In the swings of the market, where is the market making lower lows and lower highs? And then when that shifts to higher highs and higher lows. And that's where you get out with these trailing stops. Now, there definitely are other little nuances to it. Let's say you just got long right here, betting that the market's going to go up off this support level. Another thing you can do is you can just use a trend line as your trailing stop. Based on these two touches right here, I would say you can confirm a trend line off of that. And then right as the market breaks this trend line with that big bear bar, jump out of the trade. And lo and behold, that's where it reversed. And that's another good way.
I've never used a trend line, but that's 2 points. 2 points draws the line. I think, and again, this is on a minute, so this is moving really fast. This is probably another 20 or 30 minutes. In my mind, this is a pretty good sound. Especially while you're trying to learn price action, that's another good support your decision, to have that trend line drawing right there. And then once it crosses, it looks like it crossed once, but definitely if it crossed once and then it crosses a second time, yeah, go ahead and hop out. Which, again, at this point, you got like 70% of your gains. And if this was me, I probably would have taken, this is on the reversal. Once it hit here, I would have took 80%. So it would have hit here, it would have toppled out, and my 20% would have been back to here. So that'd be like 80% of my move here, and then 20% would have been on the pullback, and this would have been my take profit on that. So great strategy. Great strategy.
Way to trail your stop up. Now let's jump into a live example where I'm going to show you how I use my trailing stops in real time. So first off, here we are in a trade betting that the market's going to go down. And I initially have my stop above the highs. And for me, once the market gets going in my direction, like it makes some clear break of price action that is starting to sell off, this is a very clear example, I like to go to break even because I want to take that risk off the table. Now,
can't emphasize this enough. Boy, he hit his nail on the head. This is why I do ticks. So I have a preset number in my head. It's not in my head. It's founded in support that the instrument I trade, maybe let's say I'm looking for a maximum of 18 ticks. I know that a third of that is 6 ticks. At 6 ticks, I know typically there's support that has formed, and I'll go ahead and move my stop loss to break even. And then at that point, then I'll start trailing. But yes, I'm all over this. Yeah, I 100% agree. You need to move, find out how your instrument moves, and realize what's a good break even move to move your stop loss to break even.
Generally, I like to go with the swings in the market. So as the market swings down and makes lower lows and lower highs, I like to move down with those moves. Now, one trick I have actually found is when the market sells off this strongly, you have to break away from that normal slow trailing stop, because going with the swings in the market works great. But when the market goes so far in your favor, you need to ratchet up your stop quickly because
take the money and run. Man, my man Riley's he is killing it. He's killing it. Take the money and run 100%. You everything I've told you, I'm like, hey, I'm out at 80%. I let 20% ride. Take the money and run. Do not give your money back to the market. Do not. Take your money and run.
As you can see right here in this example, the market snaps back really quickly. And down here, I was up about $1,000 and I've given more than half of that back. And theoretically,
we don't want that. If you close out 80% here and you only give half of 20% back, that's a little bit better than giving half of 100% back. So what's half of 20%? 10%. So you made 90% of your profit. You only lost 10% at this point. Let's go.
The market could go all the way up here and knock me out of break even, and I would have felt like an idiot giving all that money back up. Yep. I saw this red bar right here and said, okay, if it breaks above this red bar, I'm going to close out. So I moved my stop here to capture some of those profits. And I got lucky here that the market did continue lower, because in reality, this is a really strong signal for the market to keep going down. But that was a really good lesson for me to learn. And I hope you take this away too, is when you get up a certain amount, I like to use 3 times my profit. I go with a really tighter trailing stop. And so to close.
So that's a 3-to-1. Again, I'm a 3-to-1 person as well. And that's why I said, like in this case, and I don't know what his risk was. I would have to go back and check. I don't know what his risk was as far as, but if I'm looking at this, maybe it was 200. So, oh, he says 3-to-1. I don't know, probably 400. He probably had $400 at risk for this trade. And again, what I wanted to emphasize is if I take 80% here or whatever my goal is, and I saw this come back and I take 80% and it pulls back and it continues to run, you got 80% of this move and it's still good and it's still going. So you got 20% still right. Don't be greedy, but take your money and run. So at this point, you got 80% close out here. this looks like half of the move that he was looking for from all the way up here. That's still good. And even with this 20% continuing down, let's see.
Close this trade out. I just saw that it was starting to go higher and I got out, and that is totally okay. Sometimes you just got to get out and pull the plug when you don't feel like you're seeing the market properly. Just to illustrate what I'm talking about, here is another example where the market puked lower in my favor. Now, generally these type of moves only happen to the downside. That's just because how the market moves. But just like the last trade, my stop was up here. It started to move in my favor, moved to break even. And then I actually moved it down with this.
Look, I like to short the market a lot. He's absolutely right. Fear makes the market move quicker. And I think that's probably why I didn't realize that. Like, in subconsciously, I knew that, but I did not realize that the market does move a whole lot faster when you're shorting things. The market like moves very fast, and like you can lock in your gains very quickly with shorts. I like to short even in a bullish market. If there's a setup that I see for a short where there's some imbalance left behind, I am all over it. I just have my structure set up so that I look for a certain thing in the market when the market is bullish to short it. I'm only shorting to a certain point. I'm not like, oh, it's going to bottom out. That's never my move. I have a goal. So just be careful when you do that. When you're taking a move, when you're taking an order against, like a retracement order against the market, if the market's bullish and you're taking a bearish order, be careful. I don't recommend it until you have some experience, and vice versa. If the market's bearish and you take a bullish order, be careful.
Wing with the price action as it started to break lower here, but as it started to really break lower here and I hit 3 times my risk, which is about $800, $700, I just ratchet my stop up to the previous candle's high. And so all that is the high of the last candle. And so this is the most recent candle forming right here. And then as soon as that finishes, I just move the stop down with it. And so that's,
yeah, his risk is like around $230. So yeah,
all I do when in a spot like this, because you can see how
he's at like a 7-1 now. That is crazy.
Rapidly this is making me up money. And when it breaks that, I don't want it to do like what we saw in the last trade of just ripping back and taking those profits back. When you're up so much money, you just have to get out. You will not get 100% of the move most of the time. And that's just how the market works. But you do not need the whole move to be consistently profitable.
So thanks, Riley. Man, he hit so many key points there. Again, trailing stops, I think, are a very valuable tool to have, especially trading. I trade futures, especially trading indexes, options. I would definitely pick this, put this tool in your belt to maximize your gains, especially. So he's trading on a 1 minute. Seems like he's a scalper, and a lot of people, I think, are moving to scalping ways a lot. There's some swing traders and day traders. However, I find that most new people are kind of catered more towards I'm trying to word this correctly, the allure of being able to get in and out of the market quickly. So great stuff, Riley. Go check this guy's channel out. I think this is a great video to review. Very intelligent, smart guy, and sounds like he's really on top of his game. He explained trailing stops and his methods in implementing trailing stops very well. So yeah, go check this guy out. You guys have a great day. This is C3 Christopher Campbell. It's the Investment Process Channel.